But it's also the money market side of the side that's also actually crumbling in trade. We have the rupee, which in fact hit a 7-week low the last time I checked. Bond markets, well, over there it has cooled off a bit by about 10 to 12 basis points from Friday's session. But we have Poonam Sani joining us with the detailed setup. And Poonam, tomorrow as well will be a very eventful day. We have the RBI monetary policy decision.
That's right, Mobina. In fact, firstly, just look at the rupee. Yes, we did hit a 7-week low in today, and that's because of weak equities as well as the dollar demand coming in there. But the US dollar index also has strengthened slightly to a 2-week high, and that also is leading to some amount of pressure in terms of across the Asian currencies. Not just that, some cool off certainly, especially in terms of the US bond markets, wherein we are seeing the yield cooling off nearly around 18 bips since yesterday. In terms of India also, we are seeing India bond yield pretty much slightly stable in today's trade at 7.55, but again that's cool off from 7.67 highs. But of course all eyes would be in terms of the RBI policy expectations, and I guess bond markets would be especially watching out for that, along with currency markets, of course, because how the RBI in fact goes ahead and perceives the slower fiscal consolidation path and higher fiscal deficit would be very important for the markets overall. In fact, most likely we should be seeing a status quo coming from RBI, the rationale being that we are at a very nascent stage in terms of recovery. There are inflation risks, but hence RBI may still maintain the neutral stance. Having said that, their commentary may still be very much hawkish. Are we off? Is the rate cut cycle has ended? Well, majority do state that yes, 67% state that we are at the bottom of the rate cut cycle, but nearly 50% see a pause in 2018. 33% expect hike by 25 bips, and close to 17% expect 25 bips cut in 2018. So the jury remains divided in terms of that. Most of the economists expect that we may see some cut in terms of GVA forecast from RBI, and RBI may also go ahead and revise the inflation forecast upwards. So watch out for that. RBI may also support the markets in terms of the OMO purchases. So watch out for that. But most importantly, again, for the bond markets, watch out for how RBI perceives the inflation risks, crude oil prices, MSP increases, slower fiscal consolidation path, and what is RBI's view if it all Fed really goes ahead and hikes rates by more than 3 times in 2018. As of now, some sanity in terms of the bond markets, but rupee, of course, is at a 7-week low.
All right, Poonam, thanks a lot for that. In fact, we'll discuss that and much more with Ananth Narayan, the money market expert who joins us right now on the show. Mr. Narayan, thanks so much for calling, for joining in. Like Poonam was just flagging off, we have the rupee, which is perched at a 7-week low, but of course we have a slew of other data as well that did come out from the budget. We had that fiscal slippage in 2017. We had the target as well actually being relaxed for the next year. So let's start off first with what your overall prognosis is for the rupee. The currency is already at a 7-week low, but I think most of it can be attributable to the fall in the markets. But do you think that there may be some reason for this weakness in the rupee, something more fundamental perhaps?
Yeah, afternoon, Mubina. Look, the fact is, over the course of the last few weeks, we have seen a noticeable deterioration in the macro and fundamentals for the country. Our financial stability is looking a lot worse than it was the last policy review a couple of months back. So as you point out, fiscal deficit has gone up. The government borrowing program has gone up. The quality of the fiscal deficit is also questionable because the revenue deficit has gone up and capital spending seems to have come down. Likewise, current account deficit, particularly for the currency, which people don't seem to notice, our current account deficit this fiscal year is going to be the worst in the last 5 years. And it could head up even higher if oil prices were to remain here or go up from here. So that's another big threat. There's also the question of inflation. Besides the twin deficits, because the budget promises rural spending and food prices and oil prices could go up from here, you could see CPI therefore edging up as well. So that's a deadly combination of a dual deficit as well as inflation going up. And plus the external context. The global markets, as you pointed out, are looking pretty fragile right now. It's still looking like a correction rather than a complete reversal. But nevertheless, at a time of a correction, you could see flows moving out from India and emerging markets, and that can't be discounted. And the last bit is positioning. Both in rupee as well as in equity markets and all asset classes in India, there's been a lot of liquidity which has flowed into these markets. Why are equity markets where they are? Because we saw 3 lakh crores of money going into mutual fund equity funds last year. Likewise, why is rupee where it is? We've seen a lot of, I would call speculative flows coming into dollar rupee, whether it's FPI in debt, whether it's exporters selling, whether it's people borrowing in dollars and not hedging it, or just outright speculative positions. So the real risk and fear that we have is if we were to see a further deterioration of the macros, where people start to worry about the prospects for India, either because of global factors or local factors or a combination, then you could see a lot of the positioning which has been built up in rupee reverse. Now that's not the base case scenario. Rupee is still looking fine, our macros are still looking fine even though they are worsened. But if oil was to go to 80, or if global markets were to correct even more sharply, withdrawing funds from all emerging markets, a reversal in rupee cannot be ruled out, and rupee will underperform other currencies in that respect.
Okay. You've given us a very clear picture, Ananth, as to what is going on with the overall macros. But the question is, what do you think is the biggest risk for us right now? Do you think that it would be the current account deficit, as you mentioned, or would it perhaps be the currency? Do you think that the biggest risk is going to emanate from global factors and thereby hampering our markets, such as liquidity situation? Or do you think that it's more domestic in nature?
It could come through any number of factors, Mubina, but the way I would think of it is what punctures the complacency which has built up either globally or locally. Look at the global markets. The reason why you saw this massive run-up in asset prices in the US and globally was we convinced ourselves that we are in this paradigm where global growth is going to be superb. 3.9% is what IMF said it will be for this year. And yet inflation will remain very, very weak. So we had this fantastic combination of high growth and low inflation, which we convinced ourselves is going to last forever. Now, what has caused this massive correction in global markets the last couple of days is the creeping realization that inflation may not be as dovish or as benign as we thought it was. And last Friday's non-farm payroll numbers from the US seems to reiterate that part. So that's puncturing this whole theory of a very nice combination of low inflation, high growth. And in reality, you might settle at a midway where inflation tends to be a little higher than we expected and growth comes down a little lower from where we expected. Something similar might be happening in India. Stock markets have run up quite a bit on the back of liquidity, and we've got ourselves into a situation where we've started anticipating revenue growth, anticipating better results from companies to catch up with where the prices of equity markets are. So anything that punctures that story can see a big backlash. By the way, this is not a bear market. We've not seen a correction in the Nifty from 7,000 onwards. It's been pretty much a smooth sailing from 7,000 to 11,000. It's still a bit of a correction going through. So in that respect, it's probably healthy in the medium term. In some sense, the biggest risk right now for us is the strength of the correction which happens globally. As long as it's a correction, it's fine. And the second big risk is there's any number of imponderables that we have, whether it's oil prices, global sentiment towards emerging markets, our own domestic inflation story, fiscal story. It's an election year, and then finally election as we come closer to the end of the year. So no shortage of things to look out for.
And that certainly is. And in fact, a lot of experts we've spoken to as well been echoing your sentiment, because this is no way called, us entering a bull market territory, because we've seen a significant rally. This sort of a correction is perhaps termed as healthy, at least from a medium term point of view. But, I will come back on the RBI bit as well. I just want to talk to you about the Fed. 3 rate hikes is what the market is anticipating at this point of time for the year 2080. This is, of course, I believe, would be well discounted by the market. But like you said, inflation will rise going forward. Growth, of course, may slow down. But yes, inflation would rise. In that scenario, do you anticipate perhaps an increase in the frequency of the rate hikes? And also, how would that play out on liquidity on our own Indian markets, Indian money markets?
Well, it is going to be dynamic, Mubina. What's going to happen is if the Fed starts to correct very sharply, goes beyond 3 hikes into 4 hikes, then everything is interconnected. So that would have an impact on anticipated growth as well, and growth would come down. So in a sense, there is a balance which we'll arrive at. But the reality, I think, is given that the US has chosen to do some fiscal stimulus at a time when the markets are already looking pretty healthy, is causing a bit of overheating of the markets, and that is now correcting. So as I said earlier, there is no way we can stave off inflation if asset prices are doing as well as they are, and unemployment is at as low as levels as it is in the US. And the average hourly earnings print which came out on Friday alongside the non-farm payroll kind of corroborated that this is a very, very stimulated market, not just by loose monetary policy, but now by additional fiscal policy as well, which is frankly not required at this point in time. So I guess the market is adjusting to that. I think we are still in a phase of correction because, as I said, the two will balance out each other. It will not be a vicious cycle. It will be a balancing cycle where rate hikes will douse growth expectations and therefore bring valuations hopefully to more sustainable levels. And that should rub off onto Indian markets as well. This should eventually end up being a healthy correction where a lot of let's face it, a lot of the run-up we saw in Indian equities is because of liquidity going into equity markets, right? Retail money going into equity mutual funds, 3 lakh crores into equity mutual funds and 1 lakh crores last year into balanced funds. Unheard of numbers flowing into equity markets. So clearly some of that overvaluation will correct. It's a bit worrisome to see the sharp nature of corrections. Hopefully they will settle down somewhere. And the underlying story still looks good. That's the good news. Look at our PMIs. Look at our IIP numbers. They're actually, our micro numbers are actually looking a lot better than they were even 3 or 4 months ago. So while our macros are worsening, our micros are looking better. And hopefully, therefore, this combination will allow us to have a correction rather than actual reversal of the market moves.
Stay with us, Ananth. Let's bring on board Andrew Freris, CEO at Ecognosis Advisory as well. And Andrew, I'm going to take off where Ananth left off. He said it's worrisome to see a sharp sell-off in the markets, but the good news is that there will be some sort of a reprieve. There is a silver lining, at least in terms of the overall macros. What's the sense that you're getting, given the kind of sell-off that we're seeing right now, because it's so closely interlinked to what's happening globally, while there are a lot of concerns as well back home with respect to LTCG, as well as a number of other factors on the macroeconomic front?
Well, I've got 3 points here. Point number one is, can we please stop calling it a correction? This is, I'm sorry, I have to be very crude here. It's a very stupid word because it implies that somehow the markets previously were wrong and right now they are right. Nothing. A correction means the markets are falling. F-A-L-L-I-N-G. So I don't call them correction. I call them falling markets. Point number two is why they are falling. Well, they are falling because we have been expecting that they are going to fall for a very long time for 2 very simple reasons. First, the Fed has already increased 4 times and they're about to increase 3 times more. The long-term bond yields and short-term bond yields in the United States have been going all up, and the market has been, by all metrics, in the United States significantly overvalued. So there is no surprise, zero surprise into that. I sit here and I yawn. Unfortunately, we cannot time it. Okay, and I will be the first one to tell you that markets are impossible to time. However, the direction of the market, this has been expected for several months now, and it's finally happening. So there is no surprise whatsoever here. It's falling, and it will continue to fall. How far it will fall, I suspect it will fall till the relative valuation of the markets makes some kind of sense against the expectations of further increases in interest rates. Point number 3, increases in interest rates. Now, you can have increases in interest rates without the central banks increasing. Let's take the case of India, for example. Since July last year, the 10-year bond has added 100 basis points. That was not happening in a vacuum, despite the fact that the RBI has been cutting interest rates for nearly 2 to 2.5 years now, down to 6. And, of course, the budget was all the worst news you could possibly expect, because an increase in the fiscal deficit simply means that interest rates will continue to increase. I'm not a Nobel Prize winner. I never claimed to be. Years back, I was a humble professor of economics, 101 economics. The explanations are terribly simple. We're looking at it all hugely surprised, as if any of this cannot be possibly explained. Very straightforward. There you go.
Okay, point taken, Andrew. So, no need to be surprised. Basically, that's I guess the key takeaway. But Andrew, before I just go forward, Ananth, I want to come back to you with one very quick question. I can't not ask you about what the RBI is going to do tomorrow. What is your own expectations? Very quickly, what do you expect the RBI to do?
Look, RBI has very little choice here. As I mentioned earlier, the financial stability and our macros have worsened since the last policy review. Our fiscal is looking worse. Our current account deficit is stretched. Inflation looks like it could head higher. Global markets are uncertain. And we have a lot of pent up of positions built up both in the equity markets and in dollar rupee, all of which warrant immense amount of caution. So RBI has very little choice but to evince caution. I don't think they'll actually hike rates at this stage because the markets are doing their job for them. As Andrew points out, if 100 basis points of rise has already happened in bond yields since July, where is the need for RBI to follow through with hiking of rates? Between liquidity drying up and bond yields reacting to all the negative news that we've seen, I think the markets have done the job for RBI. I would rather wait if I was RBI, I would rather wait with the powder dry and step in at a time when the action would be a lot more required. I'll just add one point to what Andrew was saying. I think Andrew and I are saying pretty much the same thing, except Andrew is saying it in a more dramatic way. Nobody's suggesting that this is a surprise. At the same time, the timing was always extremely difficult to suggest. We've always known that markets have been in imbalance for a long, long time. The combination of low interest rates and high markets, high equity valuations, alongside low unemployment, is a deadly combination which couldn't last forever in the US, and that, I guess, correction is going through right now. Call it a correction of falling markets. And yes, we're going to see a correction. Now, if you had actually acted upon this imbalance 12 months ago or 14 months ago, you would have lost a lot of money. So the whole point about that Andrew also made of timing this being extremely difficult stands to reason. We are going to go through a phase where things will hopefully correct to better levels, and hopefully it will be a soft landing as opposed to a hard landing.
Right. Right, Ananth. Okay, thanks so much firstly for joining us, giving us that perspective.